Today on the Chad Slagle Show, coaching you to and through retirement.
We are going to discuss why it is so important to keep it simple when planning for your retirement.
And on our Coach's Corner, we're going to discuss the fees and risk that many of you have in your portfolio and how they can impact you.
And on our Chalk Talk segment today, we're going to show you the Rule of 100 and how it can help you set up your proper safe risk ratio for retirement.
So sit back, relax, and learn. The Chad Slagle Show starts now.
I'm Chad Slagle. I believe financial planning is about educating people and empowering them to make better decisions with their hard-earned dollars. Coaching gives me satisfaction from watching a player succeed and get better. You need an experienced team around you. The best coaches have great assistant coaches. I have brought a lot of the techniques and structure I learned from playing and coaching football and applied them to the world of investing. My goal now is to coach as many individuals and families as I can on how to get successfully to and through retirement.
Welcome in, everyone, to the Chad Slagle Show, coaching you to and through retirement. I'm Wendy Erickson here with the coach, Chad Slagle. Today on the Clipboard segment, we're going to discuss why it is so important to keep it simple when planning for your retirement.
That's right, Wendy. One of the most brilliant minds in the financial world, John Bogle, the founder of Vanguard, made investing easy for us, the Main Street investors or the small investors, by keeping it simple when he invented the very first index fund that's out there today. And the big wirehouses, of course, did not like it. They did not like him, and he was actually called un-American. However, today, Vanguard is the largest mutual fund company in the world. And the index fund created a shrewder, more informed universe of investors who shop for lower fees, save regularly, and push the industry to cut costs, and of course, the most important thing, improve education. He is the reason that a lot of you have been able to send your kids to college and save for retirement, and he did all of this by keeping it simple, eliminating the money managers and their high fees. Instead of trying to beat the index, he just tracked the index with indexes like the S&P 500.
You know, keeping things simple has helped me get through a lot of situations. Like just yesterday at my house, I was looking at where we keep the bread in the house. Okay, somebody likes sourdough, somebody likes wheat, somebody likes gluten-free. And I said, enough, I'm buying one kind of bread. Just keep it simple, and if you want it, you eat it. If you don't eat it. But it was too much going on, too many dollars spent that are wasted, so keep it simple. I like that mantra.
Keep it simple goes with a lot of things. And we talk about, you know, when it comes to financial planning or retirement planning, as you mentioned, it can be as difficult as you want to make it. You can have 15 loaves of bread, or it can be simple as you want, one loaf of bread, and it's still going to feed the whole family. And when it comes to retirement planning, it can be simple, but you have to follow a few guidelines, structure, and if you have these fundamentals in place, it will allow you to be very successful in retirement. And that's what we want to talk about today.
For me, too, keeping things simple reduces the stress of it all. And certainly retirement and money, saving your money and thinking about the future can be very stressful. So I would think that would help with our overall well-being to keep it simple.
You know, it's a very good point. People come in, of course, it hasn't been stressful. You basically pump as much money as you can into your retirement accounts at work. And it's not stressful until you start thinking about retirement. You start thinking about, well, how am I going to be able to afford to do this? How are we going to be able to buy this home, take these vacations, do this? All this is very complicated until they come in, we sit down, and we build that financial plan. And once we build that financial plan or that game plan or that blueprint for retirement, you can see it's a huge weight off of their shoulders. The stress is gone. We don't have to worry about it anymore. We basically have just one loaf of bread.
All right, I like that. It's my own analogy, but that's how I boiled it down. That's what happened yesterday to me.
There you go.
In this show, we're going to hopefully help folks keep it simple.
That's right.
Tell them what they need to know. When we come back on the Coach's Corner, we're going to discuss the fees and risk many of you have in your portfolio and how they can impact you. We'll be right back.
The number one concern of retirees today is outliving their hard-earned dollars. It is more important now than ever to educate and empower yourself to make better decisions with your monies that it has taken you 30 to 40 years to accumulate. How do you do this? By using our Financial GPS, our guided planning system. This is a 4-step process to help get you successfully to and through retirement. The first step in this process is to create clarity. Here we will help identify your goals as well as your concerns and identify what you want to accomplish in retirement. The second step, we will analyze the risk you're taking with your current portfolio, and this step will also identify exactly what you are paying in fees. In the third step, we will evaluate and assess your current plan and help identify the gap between the missing pieces. And in the fourth and final step, this is where we will work together to implement a plan of action to accomplish your retirement goals. And this process can take place at any one of our convenient locations in Missouri and in Illinois. So call now to get set up on that right path on your journey through retirement.
Welcome back into the Chad Slagle Show, coaching you to and through retirement. We are back with the coach, Chad Slagle, and his colleague, Chad Tobin. And today on the Coach's Corner, we're going to discuss the fees and risk that many of you have in your portfolio and how they can really impact you.
That's right, Wendy. Today, the way you invest your money is changing. Index funds account for 43% of all stock fund assets, and they are expected to reach 50% in the next 3 years. That is a total of almost $7 trillion in U.S. funds that don't have a manager actively evaluating its holdings. Back in 1976, when John Bogle democratized investing by launching the very first index fund, it was ridiculed and called un-American. But today, those index funds are becoming the forefront of investments. As I mentioned earlier, Wendy, they create a shrewder, more informed universe of investors who shop for lower fees, save regularly, and of course push the industry to cut costs, which is very important, and I think one of the most important things, improve education. Unfortunately, today, we still find a lot of people who are retired or wanting to retire in the next 5 to 10 years who are not educated when it comes to your monies. You might invest in places because your advisor tells you to, without any idea why you invest your money there. A lot of times we hear things, Chad, often, well, my advisor tells me I have a diversified portfolio, so I'm not worried when the market drops 10 to 15%.
Yeah, and these are common things we hear quite often. And I think, with Mr. Bogle passing away at the age of 89, we call him a lot of times, he's been a pioneer in this industry. He was somebody that kind of simplified, as you two were talking about in the open, simplified investing for the common investor to be able to make sense of how they should invest their money, and that's important.
All right, well, we're here to talk about some of the problems that you see in your business today.
Some of the problems are really concerns when people come in, again, that are retired or wanting to retire in the next 5 to 10 years. And one of those, of course, that it comes back to is fees, because fees can wipe out a lot of your gains or magnify a lot of those gains. And when we talk about fees, the different types are advisory fees. There may be different mutual fund fees, variable annuity fees. And we ask people that come into our office, well, how much are you paying in fees? And we usually get two answers. Number one, I have no idea, but I should know. Or number two, well, my advisor only charges me 1 or 1.5%. Or sometimes, Chad, we see the one, well, I'm only charged $35 or $40, and that's all they think they're being charged for somebody to manage their money. And that's why it's so important to take a look at your accounts, educate yourself on your accounts, and know exactly what you're paying in fees. And if you're sitting at home today and you're thinking, well, we don't really know what we're paying in fees, it's not your fault. You know, the main retirement vehicle that we put in today, our 401ks or our company plans at work, they came out in the late 70s. So for over 30 to 40 years, they did not have to disclose any fees until 2012 when the Department of Labor came out and said, hey, you have to start telling your employees what they're paying in fees for your account. So if you don't know, or if you don't fully know what you're paying in fees, it's not your fault, but it's time to educate yourself and know what you're paying.
Yeah, and I think, another easy way to think about it is, retail versus maybe buying things at wholesale cost. And, we often talk the mutual fund world, investing in that retail world versus that index fund world, where we like to call that the mutual fund of the 21st century. It's just, kind of more up to date, a lot lower cost, and really makes a lot of sense when it comes to investing today.
All right, so Mr. Bogle would be happy to know we all know what we're paying in our fees, or we
Yes,
should.
he would.
We
Yes.
should know. What else should we be aware of?
Another thing that's very important, especially with the volatility that we've seen in the market, and as you get closer to retirement, is you need to understand the risk you're taking with your portfolio. In other words, it's amazing how many people we see come in today, and they're in their 60s, 70s, they're retired and have been retired for quite a while, and they still have 90% of their more of their money sitting all in the market, even though their advisor says they're diversified. So the first thing you need to do is you need to stress test your portfolio. And as you can see on your screen here, this shows a risk number of somebody came in, they were to answer certain questions about their risk tolerance, income needs, where they're at. This shows you here, this person has a risk number of 79. What that means is in the next 6 months, this person has a 95% probability to lose approximately 17.9% or almost $90,000 of their $500,000 portfolio. This same portfolio could also lose approximately 36.2% or $181,000 if we were to have another 2008 like we did, 11, 12 years ago when we had the bear market, the Great Recession, Chad.
Yeah, and I think the stress test is so important, especially as you're getting near retirement. I mean, it's so important to really understand, now what your risk level is and how much risk you're even comfortable taking. And that's what this is able to show, because we see most of the time people getting close to retirement, they're not comfortable with the risk they were taking maybe 10, 20 years ago, but their investments are still set up the same.
Well, I'm certainly not comfortable with that amount of risk or losing that much money that you were just mentioning. What else do we
Well,
need to know?
when you talk about risk, the other thing is we show you the individual, they're set up at a 79, but as we ask a few more questions, find out their risk tolerance, their age, and really what they want their money to do for, as you can see here, they should actually have a risk number of 30. This is the same person, makes some changes, and now has a risk number of 30. They only stand to lose approximately now 4% in the next 6 months, as opposed to almost 18% when they had a risk number of 79. This person also could lose approximately 9.4% or $47,000 if we were to go to through another bear market like we did in 2008. So think about that. That's a 27% less in the first portfolio, or $134,000. And the thing is, making sure that your advisor's asking the right questions, Chad, and getting you set up properly with where you are now and what you want to accomplish in retirement.
Yeah, and I think the bottom line with this, and there's other things that we look at when we stress test our clients' portfolios, but the bottom line is we see people are taking on too much risk that they're not comfortable taking, but they really don't know about. So it's really great to be able to show them that.
So be educated, I think, is one of your favorite things
Be
to say.
educated is one of the most important things. You need to educate yourself and empower yourself to make better decisions with your hard-earned monies. Unfortunately, today, many pre-retirees and retirees are not educated on their investments, and then that's not your fault. A lot of people, like we mentioned earlier with the 401k, you had no idea. You've been dictated to what you should do with your money, but now it's up to you to ask the right questions, understand what you're paying in fees, understand if the market has a 10 to 15% correction, the way your portfolio is set up right now, how much would you lose? So a lot of the burden is on you, but you want to make sure you have a right guide leading you and making sure that they're discussing all of these options with you.
All right. Well, coming up on Chalk Talk, we are going to show you the Rule of 100 and how it can help you set up your proper safe risk ratio for retirement. Stay with us.
Let's go.
He's such an involved dad. He's always telling the kids stories. I remember when so-and-so said I couldn't do this, or I didn't make this team. That's what drives him. In our family, we always tell our kids to stick up for each other, stand behind one another. He feels it's his role to provide, keep us safe, and to make sure that the kids are taken care of. A lot of Chad's clients have the same traditional values, and he bonds with them. Each family has a different set of circumstances, and each family is unique and different. The common thread between all of Chad's clients is that they want the best for their family, just as he would our own family.
Welcome back into the Chad Slagle Show, coaching you to and through retirement. So we just discussed the risk, fees, and education that you have to understand when it comes to your money. Now we want to show you the Rule of 100 and how it can help you set up your proper safe risk ratio for retirement.
Yeah, the Rule of 100 is one of the most basic principles of investing, is to gradually, of course, reduce your risk as you get older. since retirees do not have that luxury of waiting for the market to bounce back after a big dip. But the dilemma is to figure out exactly how safe you should be relative to the stage of life that you're currently in. For years now, a commonly cited rule of thumb has helped figure out this answer for people. And that rule, of course, is the rule of 100, which John Bogle, the founder of Vanguard Mutual Fund Company, we talked about earlier, actually came up with this rule when he talked about and discovered index funds. The rule of 100 states that individuals should hold a percentage of stocks or riskier investments equal to 100 minus their age. So we want to show you today what this looks like on the Chalk Talk, what that may or may not look like for you when it comes to investing your hard-earned dollars, especially as you get closer to retirement and once you do retire.
And I think this is really simply a great place to start. When you're sitting down and you're able to look at your current rule of 100, how is your portfolio set up according to this rule? And it's a great place to start having that conversation to really educate and work together.
All right, so what do you exactly mean by the rule of 100?
So it's very simple, right? Keep it simple, stupid, what we talked
Love
about
it.
earlier, like you were talking about your loaves of bread at
That's
home.
right.
It's really just think about the number 100. If you're sitting at home, you have a piece of paper, write this down. Write down the number 100. Under that, put your age. And that's, of course, what we talk about. Some of your money should be safe, and some of your money should be at risk. So the rule of 100, as you can see here on the next slide, is meant to help you set up your proper safe risk ratio. So if you take a look here, let's take it a 60-year-old, for example. What this means is you take 100 minus your age, in this case 60%. That, of course, 100 minus 60 gives you 40, which means you should have approximately 40% of your money at risk, but 60% of your money should be safe or secure, where if we have a 15, 20% in the market, Chad, you cannot lose that money because now maybe you're retired or you're getting closer to retirement and you don't have time to make up for those losses.
Yeah, and I think when it comes to safe investments, I mean, you have really four places where your principal's protected as long as you follow certain guidelines. So you have your certificates of deposit, CDs, your government bonds, your insured deposits, checking and savings, and also types of fixed annuities. So those are some different investments on that safe side that you really need to educate yourself with. And of course, on the risk side, we have those index funds, mutual funds, stocks, bonds, alternative pieces to invest in, so you have to educate yourself on what's safe and what's risk.
Okay, so say I'm in my 50s, which I am, plus maybe a couple of years. I should do 50 risk, 50 safe.
Absolutely right. That's where to start. But I want everyone to understand this is not cookie cutter.
Okay.
If you're 60, it shouldn't automatically be 60-40. Again, there's a lot of variables that you need to take into consideration. You have to think about what is your risk tolerance, what are your income needs, what are your lifestyle goals, what are your family dynamics, and your liabilities and your assets, and a part of your assets are your investments. So you need to understand, we talk about that safe risk ratio, as you can see here on the screen. We take it a step further in that 60% of that money needs to be in the secure bucket, and then 40% of that money would be what we call the growth bucket. It's there to grow.
And I think, as you mentioned, Chad, everyone's different when it comes to building this plan, and everyone's income needs, lifestyle goals are going to be different. So, you know, we run into people at different stages of their life, but it's so important when they can kind of keep a simple model to kind of move forward on. It really helps them stay on track through retirement.
Okay, so it seems obvious, but the secure bucket is good because
it's secure.
Secure.
There you go,
There
right?
you go.
So keep it simple. So really what you want to do is you want to look at your portfolio and you want to split it into two different buckets, that secure bucket and that growth bucket. So as you can see here, the money that we're going to have in the secure bucket, that money there is safe. If the market has a 10, 20% correction, you know you cannot lose that money. Also, we want to make sure we set enough money in that bucket to give us an income stream that we can never, ever outlive, no matter if we live to be 75 or 105 years of age. And also, the money in that bucket is liquid. If we have an emergency and we have to get to that money, we don't have to lock in losses when it's in the market. We can go in and take money out of this bucket.
All right, and did you want to add?
I would say this is probably the most important bucket.
Yeah.
You know, when you're setting that up, this is the most important bucket to get right, and it's very hard for individuals managing their own money to do a lot of the things on this safe side.
When you're retired, you stop working, you can't really start over, so it is the most important bucket.
And the growth bucket is because I'm not quite there in terms of what I want to retire.
Absolutely. If you're 50 or 55 years of age, 45 to 50% of that money should be in the market. Why? Because you're longer term with that money. That money has to last the next 40, 50 years. So that money there is to grow. It's there for the long term. It's there to keep up with the rate of inflation and cost of living. But the key is, folks, if you have enough money sitting in that secure bucket to support your lifestyle throughout retirement, if there is a downturn in the market, you don't have to lock in those losses. So the money in the growth bucket, when the market's up, we can go in and harvest some of those gains, but when it's down, it's not as big a deal because we don't have to lock in losses. We don't have to sell shares of a mutual fund or sell shares of a stock when it's down and magnify those losses. We can wait until the market comes up.
Yeah, and I think going back, really just having that game plan, having that secure bucket set up, but also realizing the best way to reduce fees on that risk side and educate yourself on what's right for you.
All right, some good information. When we come back on our strategy play, the Chads are going to show you how to use the rule of 100 when building a game plan for your retirement.
The number one concern of retirees today is outliving their hard-earned dollars. It is more important now than ever to educate and empower yourself to make better decisions with your money that it has taken you 30 to 40 years to accumulate. How do you do this? By using our Financial GPS, our guided planning system. This is a 4-step process to help get you successfully to and through retirement. The first step in this process is to create clarity. Here we will help identify your goals as well as your concerns and identify what you want to accomplish in retirement. The second step, we will analyze the risk you're taking with your current portfolio, and this step will also identify exactly what you are paying in fees. In the third step, we will evaluate and assess your current plan and help identify the gap between the missing pieces. And in the fourth and final step, this is where we will work together to implement a plan of action to accomplish your retirement goals. And this process can take place at any one of our convenient locations in Missouri and in Illinois. So call now to get set up on that right path on your journey through retirement. Welcome back to the Chad Slagle Show, coaching you to and through retirement. On this week's strategy play, we're going to show you how to use the rule of 100 when building a game plan or blueprint for your retirement. And I would say pretty much on a daily and weekly basis, when we sit down with somebody who is retired or wanting to retire in the next few years, this is a pretty common scenario that we see when we talk about the rule of 100. We have Bob here, who is 61 years of age, still working, going to work for another year. We have his wife, Mary, who is 59 years of age. She's going to work for 3 more years. And their whole game plan is when they get to be 62 years of age, they're going to retire. Now, what they have between them, between their 2 401ks, is around a $1 million nest egg. The problem is, though, they have no pensions, so they have no income stream that's going to come in each and every month for the rest of their lives, no matter how long either one of them live. And then, of course, Bob and Mary, they'll have Social Security kick in. They're each going to get about $1,600 a month. But the problem is, though, their income goal, what they need to live off of each and every month to support their lifestyle, Chad, is $5,000 a month.
Yeah, and I think when you look at this, hey, it should be pretty simple. They only need maybe 2.5% to 3% from their nest egg to give them the life that they want. Not really talking about inflation play, but right now when we look, their current risk-safe ratio or their current secure versus growth bucket, they've got 10% sitting in that secure bucket. They've got 90% of their money sitting in that growth bucket.
And that's great when the market's going up. But when the market drops 10, 15, 20%, and you have $1 million portfolio, that's $100,000, maybe even $200,000 you're going to lose. So what we want to do is we want to make sure they're set up with that proper safe risk ratio. So these are the changes that we would make. So what we would do is we take that safe risk ratio and we would set them up when we talk about the rule of 100 very simply. And again, we're not taking into consideration, the risk tolerance, the income needs, lifestyle goals, family dynamics. Those are other things you have to look at. But just from a 30,000-foot view, we take a look at that 100 age rule. We take 100 minus their age. So what that means is 60% of their money would be in that safe or secure bucket, and 40% of that money would be in the risk bucket or that growth bucket. And we take a look here. That would put $600,000. Now this money, we're going to put enough money here to give them the other $2,000 to $3,000 a month they need to live off of, that we know that money is going to come in each and every month for the rest of their lives, no matter how long they live. That's going to basically supplement and give them that pension income that they need. Also, it has upside growth. And also, we want to take a look in this bucket. This can be for legacy or long-term care if they would need that. But the most important thing, this is protected, that once we have that, then we can have that other 40%, Chad, in that growth bucket, that other 400,000, that if the market's down, not a big deal, we don't have to lock in those losses to use as income. What we can do is we can wait for the market to come back up and harvest some of those gains. So this money here is to grow, there to keep up with the rate of inflation, to give them, we talk about income, if they need it from that, but also long-term mindset.
Yeah, and I think when we talk about and we ask them, what's most important about their money, sure, they'd like to make this $1 million turn into $2 million, but if that $1 million turned into $400,000, they told us they were going to cry pretty hard. So it was so important to really revise that game plan and get them in a more comfortable situation.
Cry pretty hard, go back to work, and maybe start over with retirement. Does your portfolio need more protection from a downturn in the market? Do you need help connecting you to your money and building a game plan for retirement? If so, we encourage you to give us a call today, and that's this week's Strategy Play.
If you have any questions about today's show, or if you'd like for us to discuss a new topic, email us at askchad@slagelfinancial.com to have your questions answered on the show. We'll be right back with some of the key takeaways from today.
Your host and coach, Chad Slagle, and join
I'll be with you guys in just a few minutes.
When it comes to your health, your life, your family, your home, and your hard-earned dollars, of course you want to make sure you're working with that sharp, energetic, knowledgeable individual that is always looking out for your best interest.
Such short notice, appreciate it.
Thanks. It's time to get your financial house in order. This is the new age of retirement planning. In the Wall Street world, that's what they talk about. You got to have equity. Back into the Chad Slagle Show, coaching you to and through retirement. We are Slagle Financial. Call now, 888-294-9248.
Welcome back one more time to the Chad Slagle Show, coaching you to and through retirement. We've covered a lot today. What would you say, Chad, are some of the key takeaways?
Number one, Wendy, of course, know the fees that you're paying on your investments. Not only the advisory fee, but also the fees for the investments that you're invested in. Number two, understand how much risk you have in your portfolio. In other words, if the market were to have a 10, 20% correction, how much of your portfolio would you lose the way that it's allocated right now? And number three, educate yourself on your investments and what you want your money to accomplish in retirement.
Slagle Financial and their team of advisors have educational events coming up in your area to make sure you are prepared for today's retirement. For more information and to sign up for one of these events, call 888-294-9248 or visit chadslagleshow.com.
Remember, folks, success is waking up in the morning, whoever you are, wherever you are, no matter how old or young you are, and bounding out of bed because there's something out there that you love to do, that you believe in, that you're good at, and you can hardly wait to get at it again today. At Slagle Financial, realize that this is bigger than our team. It's about educating you, the public, and our wonderful clients, and empowering you to make better decisions with your hard-earned dollars. For my colleague, Chad Tobin, my co-host, Wendy Erickson, this is the coach, Chad Slagle. Thank you very much for joining us. We look forward to visiting with each and every one of you next week.
Clothing for the Chad Slagle Show is provided by AL Custom Clothiers, a custom men's clothier that understands the value of offering our customers the best for less. ALCustomClothiers.com or 314-570-6000.